Welcome back to Investments 360. Still on the desk, we have Wayne McCurry from Momentum Investments and Alwyn van der Merwe from Sanlam Private Investments. Alwyn, let's bring it home now. Let's take your views on China, on the US, and potentially throw Europe and the UK into the mix and say, what should we be doing as South African investors? And hopefully it's not running for the hills.
Look, there are many things that you can do, and I suppose this is you start with a broad question. So I guess you're asking, okay, in terms of asset allocation, what do you do from a geographical perspective? And maybe I should just share one or two ideas there. If you look at overseas markets generally, I think it is in the financial and industrial space easier to find value in overseas markets than in our own market. You don't need to be international equity analyst to uncover decent value situations as a result of the negative macroeconomic news flow in overseas markets. In our own market, relative to its own history, some of our financial shares and certainly some of our industrial shares look rather expensive to me. So that is we've got to look at that. On the other hand, if you look at our own market and then split it into the two sectors, financial and industrials in one camp, and then look at the resources in the other camp, the resources shares do appear to look attractive, but they are attractive for good reasons. As a result of the global uncertainty and more often than not disappointing earnings numbers that these companies reported in recent sets of results that they came out with, the market just simply penalized them for the unpredictability in terms of the earnings stream. And as a result of that, those shares, in terms of their own history, start to appear to look on the cheap side. I won't say they are really cheap relative to their own history, but relative to financial and industrial shares, they are trading at a huge discount at the moment. In fact, more or less at the same discount compared to where we've seen them at the beginning of 2000. So simply on a relative basis, if you only look at valuation and ignore the macro picture, surely you should argue that the value sits on the resources side. The one thing that worries me though, and maybe Wayne can comment on that as well, is that, and he referred to it in one of the comments that he made earlier, you know, I often have comfort when I buy a share on a cheap rating when earnings are deflated as well. And in the case of commodity shares, although the earnings came down, they're not really deflated. And commodity prices themselves, although they've come down by 20 or 30% as Wayne referred to, they are still relatively high in real terms if you go back 50 years. And maybe you can explain it against the background of what is happening in China. But for me, that is the concern, that you shouldn't get overly excited because commodity prices themselves, to my mind, haven't corrected to the full extent that compared against the background of really lackluster economic momentum globally.
Is that something you share as well, Wayne, on the resource side?
If you look at resource shares and just look at the pure ratings, put earnings aside for the moment, at the end of the commodity, the main commodity down cycle, which lasted for 20 years, in 2000, the PEs relative to the all-share index were lower than what they were now, and what they are now. After the 2008 correction, the PEs are more or less where they are now. So if you look back in history, the PE rating is very, very low. But of course, both of those ratings were also on collapsed or rock bottom earnings. We're probably not quite at rock bottom earnings yet. So typical example, Anglo-American price earnings ratio went to 7, which is about as low as what it's ever been. But then earnings fell 30%. The PE ratio all of a sudden now is 10. So we're not maybe looking at the ratings at trough earnings. Because if you can buy a single digit PE on trough earnings for Anglo-American or a Billiton, you're buying literally the bargain of a century, but we're not on trough earnings yet. However, also as Alban has explained, the difference in rating between ShopRite and Anglos is probably, or Anglos and SAB are probably the biggest they've ever been. Now, you can say, yes, but that doesn't take into account forward earnings. But even if you take into account the current price, but earnings in 1 year's time, the rating difference is just huge. I mean, ShopRite literally is twice as expensive as Anglo American. Now, maybe that's justified, but then what's going to happen is ShopRite must grow earnings at 20% compound in a country where the economy in nominal terms is only growing at 11%, which is a hard task. Or in Anglo American, all that's got to happen is China must stabilize and commodity prices go up, and automatically their earnings are what you expect. So your question about resources and do you buy them is entirely dependent on your own personal view of what's going to happen in China.
But just on that, Wayne, exactly, just explain for the benefit of our viewers, if you're evaluating a resource share, obviously you look at the price earnings at the moment and it's very low.
Correct.
But where do you make commodity prices at this point, especially the commodities that Anglo
and taking into account Alvain's comment that he, and Alvain, correct me if I'm wrong, but you're saying that commodity prices haven't corrected enough yet, is that correct? And then Wayne? So yes, Alvain?
I mean, it's simply just my view, and it's very tough to say whether it should fall 30, 40 or 50%. I just think against the background of Europe being in recession, the US being almost in recession, and China, although the growth rate, let's say, is about 7.5%, it's below expectations. And I would think that some of the holes that people dug over the last 10 years, that some of those holes are starting to produce more commodities. You know, I would just think in this environment, the oil price at $115 a barrel still looks pretty high to me. The iron ore price is an interesting one, because that, you know, a year ago, if you look at fines, they were selling at about $200 a ton.
And now we're at $80 a ton.
Come off to just under, $200 a ton. That has now come off to just under 100. So now that is, we've seen the correction there.
All right, that sets it up nicely, Alvain.
So
I hijacked.
If you ask me, I think there's still some scope for it to fall, but I think we're almost there.
Well, there we go. I hijacked Warren's question just to get that context.
Very simplistically, the resource cycle has been in place for 12 years, mainly because of China. Yep. If you still believe in China, you can almost draw a line halfway through the high and the low of that cycle and say this is the sustainable cycle, and on that basis, Anglo American's about 10 or 11 PE ratio, which is not bad value. So maybe it's not quite as cheap as what you would like it to be, but certainly in comparison to industrial shares, maybe not financials yet, but to industrials, it does in fact look very, very cheap. You must remember all the new production that's come on stream because of China comes on at a higher marginal cost.
You've got one more question that you can fit in there, and kind of a 20-second answer from somebody.
Just to perhaps to Alvain as well, on the financials, we've seen some of the banks reporting recently. There are elements, or there's some analysts saying that there's a credit bubble developing in the unsecured lending area. I just wanted to see what your views were on the bank valuations, as well as a possible credit bubble locally.
Alvain, and you have to answer all of that in 30 seconds. I'm sorry, because that brings us to the end of the show.
I think the big four banks, they're probably fully priced because the conditions are still pretty tough. I think the local banks first ran a better condition than the others, and I think the bubble, we haven't seen the bubble fully developed in unsecured lending. I think there's still some runway left there.
Perfect soundbite. Thank you very much. Wayne McCurry, Momentum Investments, Alvain van der Merwe from Sanlam Private Investments joining us from our Cape Town studio. And that's it for Investment 360 this evening. Thank you to my co-host Warren Dick from Investors Monthly.